Dear students, welcome for Fundamentals of Financial Accounting. According to the chapter 7, we are going to talking about the adjustment entries. The adjustment entries are the journal entries that converts accounting records into the accrual basis of accounting. So you know there is accounting concept called accrual basis. So based on that, we are going to record the transactions and events into the books. An accountant or bookkeeper has to make these adjustment entries either before preparation of the trial balance or after preparation of the trial balance. So you know this trial balance is the list of accounts which are recorded based on the dual entry concept. According to this, we are going to talk about the stocks, how we are going to record the closing stocks and stock losses, then accruals and prepayments, cash and goods drawing, bad and provision for doubtful debt, depreciation, additions and disposals of fixed assets, then goods sent on sales or return basis, VAT based on input and output VAT recording, finally the EPF, ETF and payee payments. Now let's move on to the first one, that is the closing stock. So here, according to the stocks, we are going to identify two separate adjustment entries. The first entry is the closing stock. Each and every business has three separate accounts, right? So these are recorded for inventories. This inventory is classified into raw material, work in progress, as well as finished goods. For each of them, we have closing stocks. But here, we are going to talk about the closing stock of the finished goods. The adjustment entry for the closing stock is, since this is an asset, we are going to debit the closing stock and we are going to credit from the trading account. By crediting the closing stock, we are going to reduce our cost of sales. Then inventory write-off. When there is a loss, when there is obsolescence, when there is outdated stock, what we are going to record is we are going to write off the inventory, right? So this inventory write-off is the process of reducing the value of the inventory of a business to record the fact that inventory has no value. The inventory write-off can occur for a number of reasons, such as I mentioned you earlier, the losses from the theft, deterioration, right? And damages in the transit. Sometimes it can be the misplacement. So when there is a damage, we know it's a loss for us. So since it's an expense, what we are going to do is we are going to debit the damaged stock. Then we are going to cut off that cost from the inventory. Then sometimes for this one, we can get the cash from the insurance companies if we insured our stocks. Then the cash receipt, we are going to debit the cash book and we are going to credit that value for the damaged stock account. Then when there is a debit entry and when there is a credit entry, there can be a profit from this loss as well as there will be a loss from these damages. If there is a loss, what we are going to do is we are going to record it under the financial expenses in the income statement. If there is a profit, we are going to add into the other income. But normally, what will happen is the insurance company pay less than for the damage amount. Then what will happen? We have a loss from this damage. When the insurance company pays, right, more than what we have occurred as a damage, then there is a profit for us. So we are going to debit the damaged stock and we are going to credit that value for the income statement in the other income. But if the insurance company pay less, what will happen? We are going to debit the income statement as an expense, and we are going to credit the damaged stock. Next, move into the accruals and prepayments. For a company, there must be a monthly income or monthly expense. If we look into the expense side, if we just take an expense called rent, if we want to pay for the rent owner a particular lump sum for a fixed period of time, right? If we haven't paid that particular amount over the period, then what will happen? The accrual occurs. In Sinhala, we call this is upachita. The accrual expenses are the expenses that an organization has incurred for obtaining goods and services for a specific period of accounting. But still, the payment is outstanding. This is called expenses payable or outstanding expenses as well. The value of the accrued expense is a liability for the business. So now let's see how we are going to record it. So what we are going to do is we are going to debit the relevant expense account and we are going to credit the accrued expense account. Then this accrued expense will show as a current liability in the statement of financial position. Now let's see how we are going to record the income receivable. If we are an owner of a particular company, sometimes we may receive the dividends. So how we are going to record the dividends? It's a right of us. So that particular company is unable to pay the dividend within the fixed time, we can record it as an asset. Why asset? Because it's a right of us. Then the income receivable is shown in the current assets of the statement of financial position. So these income receivables are the income received within the period of time but not have been yet received, which is known as the outstanding income. These are also known as the accrued income as well. The amount received is regarded as an asset and income receivable must be adjusted in the presenting the accrual operational result in the financial position. The accrued income can be adjusted by using this following journal entry. We are going to debit the income receivable account and we are going to credit the relevant income account. According to that, what will happen is we are going to add the remaining balance to the payment of the income. Then we are going to move into the next category, that is the prepaid expenses. So if we are going to pay insurance for a particular period, if we have more money to cover up these expenses and if we know that this is a fixed payment for the particular period of time, what we can do is we can pay it in advance. So these prepayment expenses are the payments which are paid in advance for the benefit yet to be received. Actually, it has not been received, but yet to be received. The benefit of such expenses are recorded in where? According to the current asset in the statement of financial position. So let's see what is the double entry. We are going to debit the prepaid expenses and we are going to credit the relevant expense. Now next one, I move into the cash and goods drawing. So you know the entrepreneur or the proprietor or the owner of the business is separate from the company or the firm. according to the business entity concept. Therefore, what the owner taking out from the business in terms of cash or in terms of goods are recorded as the drawing. Right? Since this person is using this amount for the personal benefit, we are going to reduce it from the total capital invested by the proprietor. In the case of goods withdrawn for the personal use, right? So we are going to reduce it from the inventory. At the same time, right? We are going to adjust the capital as well. So here we are going to adjust the cost of the goods taken based on the cost price, which also the historical cost. So let's look at how we are going to record this drawing. If the owner take a cash withdrawal, what we are going to do is we are going to debit the drawings and we are going to credit the cash. What will happen if the owner take goods? Then we are going to debit the drawings account. We are going to credit the inventory at the cost price. Now let's see how we are going to record the bad and doubtful debt. In Sinhala, it known as Bolha Adamananaya. The bad debt is an expense. To minimize this expense, we are going to provide the provision. In other words, in Sinhala, Venkirima. By through this provision, according to the prudence concept, we are going to foresee this particular expense in future and we are going to make precautions for this expense. Right? So this is happen when the company is selling goods on credit basis. Right? The amount of credit receivable is called as trade debtor or trade receivable, and sometimes that particular debtor or the trade receivable may not be able to pay. He may bankrupt or deceased. Then, if we cannot recover this amount from the debtor, we are going to record it as the bad debt. So, as a result of bad debt, the assets of the trade debtor is reduced and it has to be recognized as a loss for the business. This loss is recognized as an expense and it should be shown under the sales and distribution expense in the income statement. So what will be the double entries? We are going to debit the bad debt expense account and we are going to credit it from the trade debtors. Then what do you mean by the doubtful debt? Doubtful debt means this will be a receivable and cannot be ascertained at the date of preparing the financial statement whether this person is paying it or not. So, the provision of bad debt is estimated as a precaution for this doubtful debt. So, the provision of bad debt is estimated as a percentage and this percentage is decided by the management of the company. So, what the management is going to do is they are going to provide a fund. That's the provision, right? It is nothing but a loss to the company, which need to be charged in the income statement, right? In the form of a provision. Why we are going to provide it? Because we cannot foresee, right? Until it will be bad. And until we are assuring or we are pretty sure that this debtor will not pay us. So the double entries, we are going to debit the bad debt and we are going to credit the provision of bad and doubtful debt. This percentage can be varied within the year, right? to year depend on the uncertainty. Normally, in this time period, since most of the debtors are unable to pay, the bad debt provision can be increased. But when there is a economic growth or economic boom, then if the people have enough money to cover up the expense, we can reduce this provision as well. Now let's see bad debt recovery. Bad debt recovery is the payment received for debt that was written off and considered uncollectible. Bad debt must be reported as a loss, and bad debt recovery must be a claim as a part of gross income. So let's look at what is the double entry. So we are going to debit the cash receipt from the bad debt and we are going to credit it to the bad debt recovery account. Later, what we are going to do is we are going to transfer the bad debt recovery to the income statement since this is an income for us. Now let's look at the depreciation. Normally in your A-levels, you are familiar with these two types of depreciation. One is straight line method, Sinhala Sarla Marga Kramaya. In reducing balance method, in Sinhala we call this Heenavana Shesha Kramaya. So let's look at depreciation. So depreciation is defined as the expense of cost of an asset involved in producing revenue through its useful life. This useful life is dependent on many criteria and it has to be decided by the particular valuer. And the calculation of depreciation expenses follows the matching principle, which require the revenue earned in an accounting period should be matched with the related expenses. Depreciation expense can be calculated in variety of ways and the method must be selected based on the asset type, asset expected business use, and its estimated useful life. The annual depreciation is considered as an expense for the accounting period and it has to be debit to the depreciation account. So if the company is based in the cost principle, they can credit to the relevant asset account. But normally what companies are going to do is they are going to provide this provision for depreciation fund. Based on that, we are going to charge this accumulated depreciation and we are going to credit it to the provision of depreciation account. Right? So let's look at the double entry. We are going to depreciate and we are going to debit the relevant depreciation account and we are going to credit to the accumulated depreciation account. So as I mentioned you earlier, there are two separate types we are going to use. The first one, straight line depreciation. So this is the simple and most popular method. And here we are going to charge an equal amount of depreciation from the accounting period. So the formula used is, from the cost we are going to remove the salvage value. In Sinhala it called Sunbun Age. So from the cost we are going to minimize the salvage value, then we can get the net cost and we have to divide it among the useful life. The second method is reducing balance method. In the reducing balance method, the amount of depreciation is calculated by applying a fixed percentage on the book value. So the formula is as follows. Depreciation equal the net book value of the asset minus the residual value or the depreciation. Then we are going to multiply it with the depreciation factor or the percentage. Right? In this way, the amount of depreciation each year is less than the amount provided in the previous year. In the straight line method, we are going to charge a fixed amount, but in the reducing balance method, we are going to charge higher amount in the earlier stages and small amount in the final stages of the useful life. So next we are going to look at additions and disposals of the fixed asset. So when the companies are growing, they cannot stand along with the old assets. So they have to buy more asset for the expansion purpose. According to the LKS 16 Property Plant and Equipment Standard, right? We have to recognize it based on the initial measurement cost. So initial measurement cost is not only the purchasing cost. It come up as the purchasing cost summing with the some additional cost as also provided here. Normally this cost has to be capitalized and we have to add it to the asset value. Here we are going to capitalize the purchase cost and the cost bring the asset into the present location and the condition for the intended use must be considered. So based on that, the following cost should be added. What are we going to add? We are going to add the purchasing price, then cost of site preparation, initial delivery and handling cost, installation cost, and the professional fees. So when you have a land, you have to take the land price, then legal fee to prepare the land and the legal agreements through the lawyers. Then if we are going to modify the land, if we are going to level the land, that cost also has to be added. If we are going to take a machinery, we have to take the purchase price. If we are going to install, for the installation, we have to give for the plumber or the machine equipment operator a separate lump sum, then we have to add that value. At the same time, if we are going for a trial, right, then we have to consider that one as well. It depends according to the question. So the cost has to be, right, additional fixed asset cost has to be added to the fixed asset and we are going to credit the cash account. Then what will happen when there is a disposal? If there is an asset, if it is old, if there is a damage of an asset, then what we are going to do is we are going to dispose that asset, right? So when we are going to dispose an asset and we experience a gain, then how we are going to record it? So normally when we are selling an asset, we receive cash. We are going to debit the cash amount, right? Then we are going to charge it into the disposal account. Then the asset value based on the cost as well as the accumulated depreciation we have to transfer to the disposal cost account. So what we are going to do is here, I'm going to show you how we are going to create this disposal account. Right? So in the disposal account, in Sinhala it known as iwat kirime ginuma. So we are going to debit we are going to debit the cost of that particular asset. At the same time, we are going to credit the accumulated depreciation. Then the cash proceed, we are going to credit to the same account. Right? So when there is a profit, what we are going to do is we are going to debit that amount into the disposal account, and we are going to credit that to the where? Into the income statement. ලාභයක් තියෙන වෙලාවට අපි ඉවත් කිරීමේ ගිණුම හර කරලා ආදායම් ප්‍රකාශයට බැර කරනවා. Right? So what will happen when there is a loss? When there is a loss, what we are going to do is we are going to debit the income statement and we are going to credit the disposal account with the loss. Since you are familiar with this amount in your A levels, right? We are not going to repeat it in this one according to the adjustments. We will experience these double entries more in the sole proprietorship adjustment entries. So thanks for joining with me. Now next chapter we are going to learn the goods sent on customer on sale or return basis.